I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. The 4 Pillars of Investing is a comprehensive book written by William Bernstein that explores the fundamental principles of investing. The book is aimed at both novice and experienced investors who want to develop a deeper understanding of how the financial markets work and how to construct an effective investment portfolio. The book is divided into 4 sections, which correspond to the 4 pillars of investing. The first pillar is the theory of asset allocation, which is the practice of dividing investments among different asset classes, such as stocks, bonds, and real estate. Bernstein explains the principles behind asset allocation, such as the importance of diversification and the trade-offs between risk and return. He also provides practical guidance on how to implement an asset allocation strategy that is appropriate for an individual's goals and risk tolerance. The second pillar is the history of the financial markets. Bernstein argues that understanding the historical performance of stocks, bonds, and other asset classes is essential to making informed investment decisions. He discusses the major economic and political events that have influenced the financial markets over the past century, such as the Great Depression and World War II, and how investors can learn from these historical episodes. The third pillar is the psychology of investing. Bernstein explores the common biases and heuristics that can lead investors to make irrational decisions, such as the tendency to chase hot stocks or to panic during market downturns. He also provides strategies for overcoming these biases and developing a disciplined, long-term investment approach. The fourth pillar is the business of investing. Bernstein examines the various financial products and services that are available to investors, such as mutual funds, exchange-traded funds, ETFs, and financial advisors. He explains how to evaluate these products and services and how to avoid the common pitfalls that can arise when working with financial professionals. Overall, the 4 Pillars of Investing is a valuable resource for anyone who wants to become a more informed and effective investor. The book is well written and accessible, with clear explanations and practical advice. While it covers a lot of ground, Bernstein does an excellent job of tying all the concepts together and providing a cohesive framework for understanding investing. Whether you're a beginner or an experienced investor, this book is definitely worth reading. Asset allocation is the process of dividing an investment portfolio among different asset classes, such as stocks, bonds, real estate, and cash. This is the first pillar of investing, and it is a crucial factor in determining investment success. Bernstein explains that asset allocation helps investors balance risk and reward based on their individual goals and risk tolerance. Asset allocation is important because different asset classes perform differently under various economic conditions. For example, stocks are typically more volatile but offer higher long-term returns than bonds, which are more stable but offer lower returns. Real estate can provide diversification and a source of income, while cash can provide stability and liquidity. Bernstein stresses that an effective asset allocation strategy should be based on a thorough understanding of an individual's goals, risk tolerance, and time horizon. For instance, a younger investor with a long-term investment horizon may have a higher allocation to stocks than an older investor who is closer to retirement and has a shorter investment horizon. An effective asset allocation strategy should also take into account the correlation between different asset classes. By diversifying across asset classes that have low correlation with each other, investors can reduce their overall portfolio risk. For example, when stocks are performing poorly, bonds may perform better, providing a cushion to the overall portfolio. In summary, asset allocation is a critical component of investing, and investors should carefully consider their goals and risk tolerance to develop an effective asset allocation strategy. By diversifying across different asset classes and maintaining a long-term perspective, investors can build a well-balanced and resilient investment portfolio. The second pillar of investing, according to William Bernstein, is understanding the history of the financial markets. The financial markets have been influenced by numerous events over the years, such as wars, financial crises, and political upheavals. Bernstein argues that investors who understand how the markets have performed historically are better equipped to make informed investment decisions. By analyzing historical market performance, investors can identify patterns and trends, which can help them anticipate future market movements. For example, by looking at the performance of stocks during the Great Depression, investors can gain insights into how stocks behave during economic downturns. Similarly, by studying the performance of different asset classes during periods of high inflation, investors can determine which asset classes may be best suited to protect their investments during inflationary periods. In addition to providing insights into market performance, studying market history can also help investors avoid making costly mistakes. For example, investors who understand how the markets performed during previous bubbles and subsequent crashes are less likely to be caught up in the next speculative bubble. Bernstein notes that while past performance is not a guarantee of future performance, understanding the history of the markets can help investors make better informed decisions. By analyzing historical trends and patterns, investors can identify investment opportunities and construct a well-diversified portfolio that is better positioned to withstand various market conditions. Overall, understanding the history of the financial markets is an important pillar of investing that can help investors make more informed decisions and avoid costly mistakes. By studying past market performance, investors can gain valuable insights that can help them build a more resilient and successful investment portfolio. The third pillar of investing, as outlined by William Bernstein, is the psychology of investing. Bernstein argues that understanding human psychology is essential for successful investing because our emotions and biases can lead us to make irrational investment decisions. One of the most common biases that investors face is the tendency to be overconfident. Overconfident investors may be more likely to take on excessive risk, trade too frequently, and make poor investment decisions. Other biases that can impact investment decisions include loss aversion, which can cause investors to hold on to losing investments longer than they should, and herd mentality, which can lead investors to follow the crowd rather than making independent decisions. Bernstein suggests that investors can overcome these biases by developing a disciplined investment strategy and sticking to it. This may involve setting clear investment goals, establishing a well-diversified portfolio, and avoiding impulsive decisions based on emotions. One effective strategy for overcoming biases is to focus on the long term. By maintaining a long-term perspective, investors can avoid getting caught up in short-term fluctuations and remain focused on their overall investment goals. This may involve avoiding the temptation to sell investments during periods of market volatility or making impulsive decisions based on short-term news events. Another strategy for overcoming biases is to seek out objective information and avoid relying solely on one's own intuition or emotions. This may involve seeking out the advice of a financial advisor or reading reputable investment publications that provide a balanced perspective. Overall, the psychology of investing is an important factor that can impact investment decisions. By understanding our biases and emotions and developing a disciplined investment strategy, investors can overcome these challenges and build a successful investment portfolio. The fourth pillar of investing, according to William Bernstein, is the importance of minimizing investment costs. The fees and expenses associated with investing can have a significant impact on investment returns over time, and Bernstein emphasizes the importance of keeping these costs as low as possible. There are several ways that investors can minimize investment costs. One of the most effective strategies is to invest in low-cost index funds or exchange-traded funds, ETFs, that track broad market indices. These funds typically have lower fees and expenses than actively managed funds because they do not require the same level of research and analysis. Another way to minimize investment costs is to avoid excessive trading. Frequent trading can lead to higher transaction costs, which can eat into investment returns over time. Bernstein suggests that investors should avoid trading based on short-term market fluctuations and instead focus on building a well-diversified portfolio that can withstand various market conditions. Bernstein also emphasizes the importance of understanding the fees and expenses associated with different investment products. This includes fees associated with mutual funds, ETFs, and other investment vehicles. Investors should carefully review these costs and compare them to other investment options to ensure that they are getting the best possible value for their investment dollars. Finally, Bernstein suggests that investors should consider the impact of taxes on their investment returns. By minimizing taxes through effective tax planning strategies, investors can potentially increase their investment returns over time. In summary, minimizing investment costs is an important pillar of investing that can have a significant impact on investment returns over time. By investing in low-cost index funds, avoiding excessive trading, understanding investment fees and expenses, and minimizing taxes, investors can keep their investment costs as low as possible and increase their chances of investment success. The final pillar of investing, according to William Bernstein, is the importance of recognizing the role of luck in investing. While many investors may believe that their investment success is solely due to their own skill and expertise, Bernstein argues that luck plays a significant role in investment outcomes. There are several types of luck that can impact investment success. First, there is market luck, which refers to the overall performance of the market. In a strong market, even poorly managed investments may perform well, while in a weak market, even well-managed investments may struggle. Another type of luck is timing luck, which refers to the timing of investment decisions. Investors who happen to invest at the right time may experience significant gains, while those who invest at the wrong time may experience significant losses. Finally, there is selection luck, which refers to the performance of individual investments. Some investments may perform well due to factors beyond the control of the investor, while others may perform poorly despite the investor's best efforts. Bernstein suggests that investors should recognize the role of luck in investing and avoid overestimating their own abilities. This may involve acknowledging that some investment outcomes may be due to factors beyond one's control and focusing on factors that are within one's control, such as minimizing investment costs and maintaining a well-diversified portfolio. By recognizing the role of luck in investing, investors can avoid becoming overconfident or complacent and remain focused on the factors that are most likely to lead to long-term investment success. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.